Reducing your tax liabilities to the smallest legal amount possible is easier than you think as a consulting firm owner when your finances are in order. And if you haven't done this throughout the year, now is the perfect time to think about your finances and your potential tax liabilities. Well, in today's episode, I am going to deep dive into how accurate financials can reduce taxes for consultants. Stay tuned. Welcome to Say Yes to Profits. Here at Say Yes to Profits, we help consultants build $1 million firms while tripling their cash flow and profits without stress, struggle, or burnout. Now, our goal is to make you smile when you log into your bank account because you have more money, more profits, and you're paying less taxes. So subscribe, follow, and listen up. And as a result, we will make it rain money in your business. Now join me on the path to say yes to profits. Hi everyone, I am Octavia, CEO of Say Yes to Profits. Say Yes to Profits is a virtual CFO firm that helps consultants scale to 7 figures and beyond sooner than they think and beat the IRS tax game. Today I want to deep dive into how accurate financials can help you reduce your tax liabilities. Now, the reason accurate financials are so important as it relates to taxes is because it positions your firm to do 3 things. Number 1, comply with federal and state tax laws. Number 2, prepare your annual business taxes with no stress. And number 3, reduce your tax liabilities to the smallest legal amount possible. And who doesn't want to do that? You'll be surprised the number of consultants that pay more in taxes than they really should. Now, as a consulting firm owner, there are 3 things you must do right now to ensure that your financials are accurate and they enable you to decrease your tax liabilities. Let's deep dive into those. Number 1, you want to make sure that all of your income for the year is classified correctly. Now, this year, many businesses have received business grants and or business loans. Please understand that grants and loans should not be classified as revenue. If you make this mistake, you're actually overstating your income and the results could be a higher than normal tax bill. You're going to pay more than you should because you have more sitting over in your income that probably shouldn't be there. Now, in most cases, a business grant should be classified as other income, and a business loan will appear on your balance sheet as a liability. When you pay on your business loan, a part of your payment will include interest. The interest will appear on your profit and loss statement and is tax deductible. But the principal payments and the total amount of the business loan will be on your balance sheet. Okay? Number 2, make sure that all expenses are accounted for and correctly. Now, all expenses that are ordinary and necessary will help to reduce your taxable income. And as a result, your tax liabilities will decrease. So for example, if you've purchased expenses with your personal card and they're not on your business bank statements, those are often expenses that business owners will forget to include when it's time to file their taxes. You want to make sure that you account for those as well because, again, it can reduce your taxable income. Another example, the federal government has specific rules on how much depreciation can be deducted each year on equipment, vehicles, and buildings. Now, many consultants forget to account for depreciation or they make the mistake in how they deduct it. I recommend that you gather all of your bank statements for all of your business, checking, savings, and credit card accounts. And you or your accounting team enter all of that information correctly in QuickBooks and you reconcile the account for each account and for each month of this year. Then you want to look for every legal and ethical loophole that you can take advantage of. And honestly, there are plenty. This takes us to tip number 3. This is the perfect time to identify your potential tax liability and strategically spend. Yes, I said strategically spend to save on taxes. Now, based on your average revenue expenses for the month, you can easily determine what your potential tax liability will be at the end of this year. If you're higher than you thought it would be, this is the time to identify, going back to number 2, the ordinary and necessary expenses and spend in those areas. For example, have you maxed out your retirement contributions? Can you do that? Now is the time to do it. Another great example, have you made enough charitable contributions? You can actually deduct up to 25% for charitable contributions as of the date of this video. Another great example, are you and your team in a position or need to take additional classes or courses? This is 100% tax deductible and you should take them right now. Again, with tip number 3, you want to look at your potential tax liabilities based on the remaining months in the year and identify if it's too high, if it's too much, and how you can strategically spend to reduce it. Now, the bottom line is that getting your books up to date and accurate will position you to understand and reduce your potential tax liabilities. Here's the thing. You should not pay more to Uncle Sam than you really have to. And there are plenty of ways for small business owners to reduce their tax liabilities, but you have to know how to use the tax laws and regulations to your advantage. Once you get your books in order, when it's time to file your taxes, it should be easy and stress-free. And also, there should be absolutely no surprises. Now, if you need assistance with creating tax-ready financial records, contact our office today by visiting 𝐤𝐸𝐵𝐴𝑠𝑇OProfits.com/cleanup. 𝐤𝐸𝐵𝐴𝑠𝑇OProfits.com to learn more about our year-end bookkeeping cleanup special. If you have any questions or comments, definitely leave those below and subscribe right now to our YouTube channel. This is Octavia Conner. Until next time, say yes to profits. Ta-da!